Hello, the Singapore Exchange is implementing circuit breakers from late February, and I'm here to tell you what that means for you as an investor. Circuit breakers are in essence a way to slow down the market when things are really heating up, either when a stock is being sold down very quickly or when it's running up very quickly. And what that means for investors is that there may not be an opportunity for everybody to fully understand what's going on. So in the next couple of minutes, I'll take you through two examples of what happens usually and what will happen when the circuit breakers are in place from the 24th of February. First, let's take an example like this one here, where a stock has moved down very quickly in a very short space of time. You can see there the number of minutes at the bottom of the screen. Very sharp decline over just a few minutes. This is what could happen ordinarily, but with circuit breakers in place, we will no longer see such huge declines over such a short period. This is where this chart comes in. And you can see that we've got here at the 5-minute mark, the stock moving down very sharply. But if it moves more than 10% compared to where it was 5 minutes earlier, the circuit breakers then kick in. And that means the start of this blue cooling off period. In other words, during this 5 minutes, the stock will only be able to move within that previous 10% range. It can't fall any further. And so during those 5 minutes, it's an opportunity for traders and investors to pause and think whether they really want to keep selling down the stock much further. And then at the end of that 5-minute cooling off period, normal trade can resume. The bottom line is that no stock can fall more than 10% over the space of 10 minutes. And when I say stock, that includes other securities too. I'll come back to that in a few moments. So let's now take the example of a big rise in a stock price. And similar story, again, here's just an example of what such a rise might look like. A very big increase in the stock price. But with the circuit breakers in place, in essence, that rise is capped. Once again, 10% over 5 minutes. If the stock rises more than 10% compared to where it was 5 minutes earlier, the circuit breakers kick in, a 5-minute cooling off period starts, and then trading can resume. So, in other words, a stock cannot move more than 10% over a 10-minute period. There are some nuances to all of this. First of all, the stocks being impacted initially are those that are in the Straits Times Index and those that are in the MSCI Singapore Index, as well as stocks that are trading at more than 50 cents each. There are some other details that you should know about and you should talk to your broker about. But in essence, this is what will be implemented from the 24th of February. Also coming into effect on the 24th of February is a new error trade policy. In other words, if you've made a mistake when you've keyed in your bid. In essence, what will happen is that if you've keyed in the wrong bid, within 5% of where the stock was previously traded, the trade will stand. There is no cancellation possible of that trade. Only if your trade is beyond that 5% margin, either on the up or the downside. In other words, if you've bid or asked for a price that is more than 5% off the last done price, only then will the trade be cancelable. But again, talk to your broker about that. It doesn't apply to all securities listed on the Singapore market, and you should know some of the finer details, including the administrative fees that you might have to pay in the event of a cancellation. You can go to the SIAS website and sign up for the SIAS newsletter, where you'll hear more such details and information for traders and investors on how the market works. And naturally, you shouldn't take anything that I've just told you over the last 10 minutes as investment advice. It's always a good idea to talk to your broker first.